Hello again, TikTok. I just wanted to do another quick video today about the Bank of England and what they've been playing at recently. To me, it was like not very broadcast what they've done recently, and it's quite interesting. So everyone knows that the Bank of England base rate is slowly going up by about 0.25% every month, or 10 times a year, whatever it is. Which is not really having a massive effect, but it does mean that because it's gradually gone up, then interest rates are going up. So you'd be looking at, I think, 1.25, 1.5 Bank of England, plus the normal rates that you might be getting from the bank on top of that, so 2 or 3%. So where before your mortgage for your personal home might have been on like 1.5% or something like that, suddenly if you come to remortgage now today, you'd be looking at like 3.5 or something like that. So it can mean that mortgages are more expensive. The kind of knock-on effect of that is that first-time buyers or people purchasing a property like today go to get a mortgage, and the cost of money is more than it was yesterday. So it means that effectively people's budgets are lower. They can't afford as much because the cost of the money, cost of the loan is higher, which does have a knock-on effect on the economy because potentially house sales decrease, house values potentially decrease because people can't afford so much. So if they can't pay as much, then the value of something changes. What the interesting thing is that the Bank of England have actually taken away the stress test. So it's not to say how much can you afford based on your salary, how much is your monthly amount you can pay for your mortgage. It's not that. That calculation's still done the same. That's my understanding anyway. Like I've said before, I'm not a financial advisor or mortgage advisor. But what they've done is there was a stress test, and I can't remember what it was, whether it was 3.5 or 5.5 times the Bank of England rate. So that was like if rates suddenly went up really high to like 15% or something crazy, or like went up overnight to 5%, would you still be able to afford the mortgage? Because obviously if you have a 25-year mortgage, like you base it on today's rate of 1.25% or 1.5%, but then in 5 years time when you come to remortgage, the base rate might be 15%, so suddenly your mortgage is like so high you can't actually afford it. So how do you pay for your home? Well, they've got rid of the stress test, which was like a method of making sure that if rates went from 1% to 5%, that you could still afford it. So what it meant was, like yesterday, you could effectively borrow less because the stress test might have kicked in and meant that you, even though you've got the right amount of salary, it meant that you couldn't borrow too much, or you couldn't have monthly repayments which were too much. Stress tests were brought in after the recession in 2008. I think stress tests were brought in 2010 or 2012, something like that. They were like a sensible thing, but they did suppress how much people could borrow. So the fact that that's been got rid of is like, right, interest rates are going up, but they've got rid of the stress test. So what I was saying about interest going up, and that means first-time buyers and people buying a house can therefore buy with less money because it's more expensive, money's more expensive. Well, that's kind of not the case because they've then got rid of the stress test, which I think is to like sort of compensate for that. So it's kind of worrying because you go, well, wasn't the stress test like to stop irresponsible lending and all that sort of thing? And it was brought in on the back of a recession, which was a housing crisis and a housing crash based on irresponsible lending. So you could say, oh, well, it's a bit more risky. But to me, what it means is the kind of property cycle, the economy, it goes in 18-year cycles. It goes up quite steeply, plateaus out, sensible, which is what we're at now, and it goes up again. After that, then there might be a crash. So if the last crash was 2008, and you go 20 years from then theoretically the next crash is 2026. Everyone was saying that there might be like a bit of a crash now, or correction, or whatever you want to call it. The market has tanked, or all these fancy words. But to me, like, by the bank doing that, it means that lending can continue, people can continue buying houses, values keep going up, but slowly, like sensibly now. It doesn't mean people are losing their jobs, it doesn't mean people are losing their houses, it just means that people can borrow more money where the stress test would have allowed it yesterday, which is quite interesting because it means that the Bank of England base rate is kind of not having an effect on people buying homes. or remortgaging because they're allowed to borrow more, essentially. So to me, it seems like a good thing. Obviously, don't borrow more than you can afford, and do think about tomorrow if rates go up. But yeah, it seems like the bank have actually done something right, where, you know, I talked about inflation and everything, and it kind of felt like what they were doing was wrong. But this one, in terms of mortgages and stuff, seems like the right direction to go. To me, I can see the effect it's going to have. It means that the market won't plateau or go down, because that's, I guess, what they're trying to stop is a recession and inflation. They can't control inflation. Their hands are kind of tied, and they've got to choose between the lesser of two evils. I don't think what they've done for the last few years is definitely, I don't think it's been the right thing to do. But this sort of change to allow mortgage lenders to lend more, or your monthly amounts to be slightly higher without stress testing it and then reducing that, seems like a good move. Seems like it will avert any kind of recession, and allow the property market to continue proceeding. Yeah, I think it's good. Let me know if you know anything about it, or your comments.